Assalamu alaikum and welcome to the Focus and Finance Show. I'm your host, Shafiq Morton. As always, it's great to be with you. In today's show, we have a look at events that are flowing into what's happening on the economic landscape, locally and internationally. Events such as the China-US trade war, the disparities in growth rates in developing economies, and of course, what's happening in Brexit. And finally, we'll have a look at how this affects you and me as investors, how we can manage it, and of course, how we can take advantage of the situation. In studio with me today are Kevin Kotza and Shehzad Harif. Gentlemen, assalamu alaikum. Welcome to the show.
Walaikum salam, Shafiq.
Kevin, you've got the first innings. Tell us something about the background. What are the events that are playing into what's happening to the world and local economy at the moment?
Thank you, Shafiq. Well, global economic growth has been relatively strong and is expected to be 3.9% for the remainder of 2018 and into 2019. However, this global economic expansion has been relatively uneven and has largely been fueled by US tax cuts, which has fueled growth in North America. In addition, this geopolitical uncertainty and the trade disputes that you have already alluded to between China, US, and other major economies has contributed towards an increase in economic uncertainty. In addition to which, the euro area is also contributing to higher levels of economic uncertainty as a result of the Brexit talks and the direction that those talks are taking. Furthermore, we've seen recently in the US, they've imposed sanctions on countries like Iran and Russia, which has increased the price of oil, and this is potentially going to act as some sort of a constraint on future economic growth. Of course, it will benefit those net exporters who may benefit from some sort of a stronger position, but for those countries like South Africa, who are oil importers, it could constrain growth somewhat in the years to come. And lastly, we've seen that there's been some sort of an increase in populism throughout Europe, which has led to a more fragmented party system as the political willpower seems to be shifting to the right. Together, these factors seem to be threatening the relative stability that we've had since 1945. And over this period, we've seen tremendous increases in the degree of globalization and the reduction in tariffs. Right? All of this seems to be unwinding somewhat, and as a result of which there seems to be a great degree of economic uncertainty throughout most of the world's major economies.
Just to latch onto that, in the US, for example, where Trump talk sees a lot of very confrontational dialogue, let's put it that way. How is that going to affect us? The fact that Trump seems to want to declare war on every single country.
Shafiq, but certainly this recent change in trade policy has been relatively dramatic. The US has imposed a tariff now on 10,000 categories of goods, and this would include this 25% tariff on Chinese goods, which was imposed on the 6th of July, and that is to the tune of $34 billion. China has since retaliated, and as a result of which we've seen that the US is now considering imposing 25% tariff on what is $200 billion of goods, which is a really large and substantial tariff. The estimated cost of these trade disputes have been estimated to be in the tune of about $100 billion. And the Financial Times have recently announced that they could expect that this could rise to a figure of $1 trillion.
Wow.
Which is 6% of trade, if there is huge amounts of retaliation. But it's important to contextualize these numbers in terms of what the impact is going to be on economic growth. Because economic growth is ultimately what's going to affect the welfare of society. And what we've seen over recent periods of time is that trade has not been such a strong impetus for growth throughout the global economy. And this is reflected by the change in the trade to GDP ratio, which was prior to the global financial crisis at a value of sort of 1.5. So trade is growing 1.5 times faster than GDP, whilst over the last 5 years, it has come back to a ratio of 1.
Mm-hmm.
This would suggest that trade is not quite as large a component of an impetus for GDP growth. And according to recent stats that have been released by the IMF, which includes some of the potential effects from this trade dispute, we see that the ratio of trade to GDP is expected to stay at 1 for the next 3 years, which will take us through to 2021. In addition to which, we've had a report by the OECD recently, where we see that global economic growth may need to surrender 14% over the next 40 years if we are going to return to a point where we had tariffs that were equivalent to those in 1990.
Interesting stuff indeed. Shahzad, let's see how we've allayed some fears, but how does all of this play into developing and emerging economies such as ours in South Africa?
Thank you, Shafiq. So emerging markets have been under pressure for at least the past 3 to 4 months, right? And this was mainly driven by a reduction in global liquidity, which is basically a reduction in stimulus packages by governments of various countries. Secondly, we are having a rising interest rate cycle whereby the cost of borrowing is increasing in most countries. And lastly, as Kevin mentioned, the ongoing trade uncertainties. So all of those are actually affecting emerging countries. But what is really happening is that there is an incentive for a flight to quality, which means that people see certain currencies as safe havens, right? So what they do is they go to currencies such as the Swiss franc and the USD, which have been appreciating in value over the last few months, just so that they protect themselves, right? But in return, what this is doing is it is affecting emerging currencies. And that's what's happening to the rand, that's what is happening to the Turkish lira. And the ultimate result of that is an outflow of funds from emerging countries. So we know that foreign direct investment, those are needed for growth. And if we don't have those, then we'll stagnate somehow. And that has been happening recently, and the outflow of funds is actually affecting all the asset classes in emerging countries. And if even we look forward now, what is happening is the US is hiking, right? They are in a hiking cycle for interest rate, especially countries that are exposed to foreign debt, right? If you have countries such as Turkey, South Africa, we have foreign debt, and also coupled with that macroeconomic imbalances. So we will be even more affected by those. And if you look at South Africa with the trade dispute, what is going to happen is we have a high export ratio. So we export quite a lot. And with exports, we get an inflow of foreign currencies, which contributes to economic growth. But with all those trade uncertainties, and recently the US, I think President Trump was saying that they started looking at what is happening in SA and everything. So all those are contributing to a more volatile currency. Every day the currency is moving and it's very volatile. And economic growth, as reflected in the second quarter, is slowed down, and obviously we adversely impacted.
So apart from international factors, what else can affect the South African economy?
So the South African economy is currently vulnerable to negative effects of the economic shocks, right? So beside the deep structural issues that we have in the economy, such as the land reform, health issue, education, the mining charter being unclear, the economic fundamentals are currently weak. We are currently in a twin deficit, which means that we both have a fiscal deficit and a current account deficit. In the first quarter of 2018, if I'm not mistaken, the current account deficit increased to 4.6% of GDP, which is quite high. But although we had a slight improvement in the second quarter, it came down to 3.3%. But what we need to understand is we are still in a deficit situation. And the final forecasted figures for 2018 is, I think, around 3.3% of GDP, a deficit. So the fiscal debt on one side and current account deficit on the other side, both creating pressures on the economy. The fiscal debt as of 2017 was 4.6% of GDP, and that figure is forecasted to increase further. So in addition, like I said, fiscal debt is increasing as a result of the outflows, and we need more inflows for growth. So what's putting pressure, what's interesting is that state-owned enterprises are putting pressure on the government because they're in dire need of funding. They find themselves in a position where they don't have cash to run their daily operation. If we just take, for example, Eskom, in their last set of results, they reported a loss of 2.3 billion for the financial year. And this was mainly driven by an increase in finance costs of 32.5%. So just imagine, like, your interest cost is 32.5% contributing to your loss figure. And they also have a negative annual cash flow of 47 billion, which is huge. To further compound the situation, the net debt situation in which Eskom finds itself is quite bad, and they actually require cash and funding to operate on a daily basis. Their current debt level is expected to increase from around 400 billion to 600 billion now. And the issue is, where will they get that funding? Because they are already in a situation where banks won't lend to them because they're not credible as such. And the only way they can do that is by issuing government guaranteed bonds. That what they have been doing previously. The government has a ceiling of 250 billion, and they actually already nearly there. So the question is where to find the funding. And if I'm not mistaken, they have almost secured funding for the next financial year, but they find themselves in a dangerous situation in the sense that they are actually borrowing to fund existing maturities. So to fund existing debt, they're just replacing it, taking debt to finance debt. And also they might reach a situation whereby they might need to borrow to fund the finance costs. So that would be a really difficult situation for them.
Right, the lights are still on, and it's the Oasis Focus and Finance show. We're having a look at the current economic situation locally and internationally. When we get back from the break, we'll wrap up the Eskom story, and then we will also show how you as an investor, as I as an investor, how we can manage and also actually benefit from the situation. We'll be back right after this. And welcome back to the Oasis Focus and Finance show. Today we are having a look at the economic conditions globally and of course locally, and also looking towards solutions and how we can manage and even benefit in terms of investment. But before the break, we were talking to our guest Shahzad Harif about the situation at Eskom. Shahzad, let's start off. How long will it take for Eskom to dig itself out of this big coal hole?
Thank you, Shafiq. So we actually estimate that before they start deleveraging, they'd need at least 4 years. So the 4 following years, they will still be taking on debt. And only after those 4 years, they'll be starting to ease on that. But if we think about it, what is really needed is some sort of capital injection. They don't need debt anymore. They actually need equity capital. But what they actually need to do is to come forward and propose to the investors and all the stakeholders a credible plan as to how they are going to turn around the situation.
Indeed. Now, Kevin Kotze, let's have a look. The path to economic growth in South Africa. How do we build this path?
Well, Shafiq, it's not easy. So to transition from this path where we currently are with geopolitical uncertainty, slow growth, high levels of debt that Shahzad was alluding to, we need some sort of a bold leadership. We need some sort of macroeconomic reforms, and we need to remove all the supply side constraints in the economy. In addition to which, we can think about the urgent need for a much improved fiscal management system, which is going to allow for institutions such as SARS to better collect taxes and raise revenue for government. Right? As a result of which we would then see some sort of a decrease in our fiscal debt. In addition to which we also desperately need a more flexible labour market. We need access to better and high levels of skill, and as a result of which, should we obtain access to these much needed skills, we would potentially see some sort of a dramatic increase in growth and productivity, as well as in our employment numbers as well.
So how, as investors in South Africa, do we manage our investments in this current climate?
Well, Shafiq, diversification is the key.
Right.
And it is the key to long-term wealth creation more generally. And during these current periods where we've got high levels of geopolitical uncertainty, we really can't emphasize enough the benefits that might be derived from some form of diversification. So during the accumulation phase, when we all of us here are investing or contributing towards some sort of investment scheme, we need to think about some sort of a diverse portfolio which is going to minimize the risks that we are subject to. And if we spread the risk amongst various different assets or shares or instruments, we would be able to decrease our exposure to risk in a dramatic manner. This type of diversification can be accomplished through various different means, and we can think of introducing some sort of a geographic diversification where we're investing across different countries. We can think of some sort of a currency diversification where we're investing in assets that are denominated in different currencies. We can think of asset class diversification, such as investing in shares, bonds, sukuks, or various other sort of instruments. And we can think of diversifying across different sectors, right? So maybe having a shareholding in the mining sector, in the property sector, and all sorts of other sectors that one could consider. Okay? And this, in essence, is the most basic form of managing your risks appropriately.
Right.
And it's the method that is going to get you the highest percentage return per unit of risk that you take on. There have been many occasions, if we think about in the past, where investors are focused too much on the short term, right? And this short-term focus is really creating some sort of a headwind towards long-term wealth creation. And an example of short-term thinking is where you're trying to time the market. This is clearly going to be a relatively poor strategy, as many people struggle to time the market correctly. The converse of that is what people should be looking to do, and that is to stay in the market. Right? So if you are prepared to invest over the long-term horizon, you're more likely to weather the storm that is presented by volatility. In addition to which, stock pickers like ourselves can benefit from some sort of a short-term market volatility where we see the prices of a number of assets would decrease over periods of time, and that would provide us with an opportunity to buy these assets relatively cheaply.
So in other words, one egg in one basket, and it takes a long time to hatch the egg. Shahzad, tell us something about diversification. How do we go about this?
Oasis has a range of balanced funds that have been designed specifically to allow its client to benefit from all sorts of diversification in a single product. In addition, one has the ability to increase its geographic diversification by investing in offshore funds, right? So how do you go about doing that? there are three broad ways in which you can achieve that. Firstly, by virtue of investing in one of our saving products, you benefit from that 30% foreign exposure, which is already inbuilt in our asset allocation. So we already cater for that. Secondly, we offer 3 rand-denominated international feeder fund that invest directly in our Sharia-compliant global mutual funds. Thirdly, investors can transfer funds directly into our global mutual funds, thereby accessing all the international markets that we are exposed to and all the major companies across the world, right? So when investing offshore, what is important for South African investors is that they need to know that they can invest up to an amount of 11 million, right? Which is split into 10 million as foreign capital allowance and 1 million as discretionary allowance. So the benefits of diversification can be best assessed through a financial advisor, because everyone is in a different life cycle, and a financial advisor would be best suited to advise you into and direct you into which fund you need to go. And to conclude, I would like to say that our excellent service and administration makes it convenient, affordable and accessible for local investors seeking offshore exposure, diversification and long-term growth.
Gentlemen, thank you. Merci beaucoup. And that concludes today's edition of the Oasis Focus in Finance show. And a special thanks to our guests, Kevin Kotzer and Sherzad Arif, when we had a look at the global and local financial situation and also looked at how we can manage it in terms of investments and actually benefit from it. Should you wish to watch this or any of our other shows, you can log into the Oasis Crescent YouTube channel. Should you wish to contact us, you can dial 0860 100 786 or email info@oasiscrescent.com. From myself, Shafiq Morton, until next time, Assalamu alaikum wa rahmatullah.